Good morning. Today is Friday, the 20th of October at 7:13, actually now 7:14 a.m. Pacific time. So today, let's talk about options chains. What is an options chain? So here's what it looks like. This is on Invesco QQQ, which is a NASDAQ ETF. And as a reminder, an ETF is an exchange traded fund. It's basically like a stock, but this particular stock, it follows the direction of the NASDAQ index. So if the NASDAQ index goes up or down, this follows that, but you can buy individual shares. So anyway, more on that in the future. I just want to show you what the chains look like and what the different components are. So you can look at calls and puts, which this side, the left side, are calls, the right side are puts. Calls, as a reminder, will increase in value when the underlying stock goes up, and puts will increase in value when the underlying stock goes down. Now, there's some variables such as time value, which make it not necessarily always the case. As you see here, today these expire, these options here. Down here, these expire on Monday. But let's look at this time frame. So you see all of this, the change is red. You see this, the change is also red. So why is that? Well, these expire today. So the time value that's remaining is minimal. We have until 4 p.m. Eastern, 1 p.m. Pacific before these options all cease to exist. And when they expire, the question is, will it expire in the money, in the money or out of the money? This blue shading here and here, it makes it a visually easier thing to perceive. So if it's blue on the call side, then it's in the money. What does in the money mean? In the money means that the underlying stock, which is the QQQs, okay, it's at, let's call it 358 because it's obviously changing constantly. That means that this price is above 357, 356, 355, etc. And in fact, I'm going to expand this strike price. I'm going to put all. So now you see a wider selection, okay? And then of course, you can scroll up and down. So I'm going to scroll toward the area that we were looking at earlier. Okay, so what is a strike price? A strike price, think of it like a football field. The stock, it moves up and down, just like the football players, and the ball moves up and down the field. That's a constant change. This here, consider these like the yard lines. The yard lines, they're set in the ground. These strike prices, they're set in the ground. These don't change, okay? You can go up and down the football field, but this is what changes. This is what's going up and down the football field. So when you buy or sell an option, you have a strike price that's attached to that option. When you buy or sell that option, that strike price is stuck. That it's like having a tattoo on your arm that you can't remove, okay, until expiration. So if you buy, as an example, a call option with the strike price of 356, you want the stock to be above 356. The higher it goes above 356, the more this option will be worth. Okay, so when you look at the top column, what do all these mean? The last price is the most recent price of the option. This 263, it really translates $3. Why does it have this decimal? Well, it's $2.63 per share. But remember, every option leverages or controls 100 shares of stock. So you always multiply the last price on options by 100. If you have two options, you multiply it by 200, three options by 300, etc. Okay. The bid and the ask. What are those? The bid price, notice there's a gap between the two. The bid price is the price that someone who's looking to buy this option, that's how much they're willing to pay. So they're putting it out there and saying, hey, I'm willing to pay this. If you come down to this price, I'll buy it. The ask price is the price that sellers say, I am looking to sell at. If you want to come up and pay 256, then it's yours. If you don't, then we have to wait and see. Something has to budge. Otherwise, they're going to sit and wait and not do any transactions. Okay, now this is another conversation, but there's a lot of bid prices and there's a lot of ask prices. So these two prices are the closest to each other. There's other potential buyers that say, hey, I'm going to bid 252, 251 or lower. There's other sellers that would ask 257, 258 or higher. There's people that want $3 or 3.00, but they're far away from it. So they can wait forever. They can make adjustments. Anyhow, that's how that works. Now I'm going to make a quick refresh here so you can see just a more recent price. Let me scroll back down to where this line here is what you call at the money. That's the closest level that you're at to the current underlying price. Okay. So anyway, if you buy an option, a call option with the strike price of 356, that basically gives you the right, but not the obligation to buy this stock at $356 per share. So you have the right to buy it cheaper than it currently is. If this thing goes up to 380, you would still have the right to buy this at 356. So you have a huge discount. The bigger the discount, the more profit that you would have, because you can buy it at 356 and dump it at 380 because you have the right to do so. Then if this goes down to 350, you have the right to buy it at 356. But why would you? You can buy it on the open market at 350. That will make this call option at some point shrink down to nothing. So when I trade, I'm basically, I hate to say betting, but for lack of a better word, betting that it's not going in the money. I'm betting it's going to stay out of the money and expire worthless. Now on the put side, if you if you buy a put with the strike price of 356, you have the right to sell, not to buy, you have the right to sell QQQ, the stock, at 356. So you want the stock to go as low as possible. Let's say it goes down to 353. You have the right to sell it at 356, which means you have the right to sell it for more than the general public because you have the legal right to do so because you bought the option to do so, only for a selected amount of time. So we'll review this more and more over time. Okay. You see the bid and the ask. These are really close together, which is nice. Whenever you see a bid and an ask that's very close together like this, obviously you can't get closer than this. This is 1 cent apart. That means if you buy, you would buy this price, and if you sell, you would sell this price. And so it's only 1 cent difference, meaning you're behind the ball by 1 penny, but it's easy to break even because to recover a penny is a lot easier than recovering 2 pennies or 3 pennies. Okay. So this is the volume. This is the open interest, what's available. So let's scroll. Let's look at some other times. So we have expiration dates, I should say. We have Monday. What you'll notice is as you go further down on the time, October 23rd, October 24th, the same strike price. Let's pick one. Let's say 360. Okay. The last price is 168. Now let's look at the 360 for the next day. It's 238. You notice there's a difference in price. Time is money. They say time is money. This is literally the case when it comes to options. The more time you have, the more something can happen. If you have an option that expires a month from now, all kinds of things can happen. If you have an option that expires today or Monday, there's not as much time for something to happen. So it's as if, let's say you have a school project or a work project, and they say, get this done by 5 p.m. today, you got to scramble. That's a lot of pressure. It's not as likely for you to get it done. If they say do the same project, but do it by next Friday, you may not do it then, but you'd have more of a chance to. You'd have more time on your side. So when I sell options, I'm like the boss that says, you better get this done by 5 p.m. or maybe by Monday at 5 p.m. And so by doing that, the odds are on my side that the underlying thing won't happen for the other party. I don't like to sell options necessarily that expire months from now. Sometimes I do, but I choose not to for the most part, because then the odds become more on their side than on my side. So time decay is a big thing. Another way to put it, which is a little bit morbid, is let's say there's an old lady that's 90 years old. And now, all of a sudden, she says, hey, I want to start taking supplements. I want to start exercising. I want to start eating healthy. But up until then, she really didn't. Well, it's not too late, but it is. The time decay is working against her, right? It's not going to make as much of a difference if you start late. So that's morbid. That's just an example. I hope it makes sense. Hope it doesn't offend anybody, but I'm just trying to relate the material in a real world way. Okay. So as you scroll down, you'll see further expirations. Now, you'll notice these are daily expirations. If you look at something else, let's say we look at Apple. This is the ticker for Apple. Okay. And let's say we look at, I just put 120. That's the number of days we're going out. So you'll see this day's today, then we have next Friday, the Friday after, and it's just on Fridays. A long time ago, when I first started trading, we only had monthly options. It would be the third Friday of the month. Now we have weekly options. So there's more opportunity, which is fantastic for options sellers or options writers like myself. Okay. One last thing. Let's look at the Greeks. So the Greeks are right here. There's Vega, Theta, Gamma, Delta, and implied volatility. Vega, do I have the calculation? No. The platform or the software or the website, whatever you want to call it, it automatically calculates for you. Theta, and that is a volatility calculation. Theta is a time calculation. It's the decrease in value on any given day. And these numbers will change, from time to time. The gamma is the change in delta, and the delta is Well, it's looked at two ways. It's the change in the underlying options value as it relates to the stock. So if the stock goes up or down by $1, the option would move by $1 or a fraction of $1 in theory. This is all theoretical. Also, the delta determines the probability that the option will be in the money. So Apple's at 174.22. Let's say we're looking at a call option, which is on this side of a 175 strike. So right now, that means this call option is out of the money. This one is out of the money. Anything with the higher strike price is out of the money on the call side. All of these are in the money because Apple is above here, but below here. Now, the delta right here, 34.79. So that means there's a 34.79% chance that Apple will close today, because that's what this option expiration is today, above 175. So there's a just over a 65% chance, 65.21% chance it will stay below 175 as of right now. That could change, and it can go above this, and obviously all of these numbers will change. So I know it's a lot to digest, and if you have questions, post them at the comments section. Thank you for watching. Have a wonderful weekend.